Welcome back to the channel. Sometimes the market does things that make you question your own sanity. If you had told me on New Year's Eve that silver would rally 24% in the first 2 weeks of January, I would have asked you what you were drinking and whether you could share some with me. But here we are. It is January 2026, and the precious metals market has officially lost its mind. Let that number sink in for a moment. 24% in 2 weeks, not 2 months, not 2 quarters, 2 weeks. The last time silver moved like this at the start of a year, Ronald Reagan was in the White House, everyone was wearing shoulder pads, and the mullet was considered peak fashion. We are talking about 1983, that is 43 years ago. Most of you watching this were not even born yet. Some of your parents were not even born yet. And yet here we are, living through history, watching the precious metals market rewrite the record books in real time. Gold is up $256 so far this month. Silver has surged nearly $70.50. In percentage terms, gold has climbed 6%, which is already approaching last year's entire January rally of 7%. But silver? Silver decided that 6% was for amateurs. Silver went full send. By now, you have probably seen the headlines. The mainstream financial media is calling it a historic rally. They are interviewing analysts who are scratching their heads. They are showing charts with lines that go almost vertical. It is a spectacle. But while the media is celebrating, something else is happening, something that the casual observer might miss. The rally is slowing down. Gravity still exists. This is not bearish. Let me be clear about that. This is not the end of the bull market. But this is a moment of reckoning, a moment where the market pauses, catches its breath, and asks itself a very important question. What now? And the answer to that question lies not in the charts, not in the technical indicators, but in a single announcement that came out of Washington, D.C. late on Wednesday. An announcement that fundamentally changes the narrative that powered this entire rally. President Donald Trump, following a Section 232 tariff review, announced that his administration will not impose tariffs on critical metals. For now. Those two words at the end are doing a lot of heavy lifting. For now. But the market does not care about nuance. The market heard no tariffs and immediately started recalculating. You see, the supply crunch narrative that powered silver prices higher through the second half of 2025 was built on fear. Fear that tariffs would disrupt the flow of metal. Fear that the United States would be cut off from global supply chains. Fear that the silver sitting in London and Mexico would become too expensive to import. That fear drove a massive stockpiling operation. For nearly a year, the United States has been hoarding silver like a squirrel preparing for nuclear winter. Dealers, banks, industrial users, everyone was scrambling to secure supply before the tariff hammer dropped. But the hammer did not drop. The storm clouds that had been gathering on the horizon suddenly parted. And the market is now asking itself a question that nobody wanted to ask 2 weeks ago. What happens when the fear goes away? This is the question we are going to answer in this deep dive. We are going to deconstruct the historic rally that just occurred. We are going to explain why silver moved 24% in 2 weeks, and why that move was both rational and irrational at the same time. We are going to analyze the Trump tariff decision and explain what, for now, really means for the physical market. And most importantly, we are going to look ahead. Because while the short-term narrative has shifted, the long-term fundamentals have not changed. The supply constraints that drove this rally did not disappear overnight. They simply took a step back into the shadows. But before we go deeper, I need to address something important. We are the original source of this analysis. We spend hours digging through the data, connecting the dots between geopolitics and finance, so that you can understand what is really happening. Unfortunately, we have noticed copycat channels popping up, stealing our research and presenting it as their own. If you appreciate the work we do here, please help us protect this community. Drop a comment right now saying, "Staying with the original." Let the algorithm know that you are here for the real analysis, not the copy-paste imitation. Now, let us get back to the crisis at hand. The 2-week rally we just witnessed was not normal. It was not organic. It was the culmination of months of tension finally releasing. Think of it like a pressure cooker. The steam had been building since the summer of 2025. The tariff threats, the supply chain disruptions, the relentless demand from China and India, all of it was adding pressure to the system. And then, in the first 2 weeks of January, someone opened the valve. The price exploded upward. Shorts got squeezed. Momentum traders piled in. The algorithms that dominate modern markets saw the breakout and started buying automatically. It was a cascade, a chain reaction, a waterfall of capital flowing into the precious metals market. But waterfalls eventually hit the bottom. And that is where we are now. In the next part of this deep dive, we are going to examine the anatomy of the rally. We are going to look at why silver outperformed gold by a factor of 4. We are going to explain the concept of the gold-silver ratio and why it just hit a level not seen since 2012. The first 2 weeks of January were historic, but history is not finished being written. The question is not whether the rally was real. The question is whether it can continue. Stay with us. Let us break down what actually happened over the past 2 weeks. Because understanding the mechanics of this rally is essential to understanding what comes next. Gold is up 6% in January. That is impressive. That is already approaching the entire 7% rally we saw in January of last year. In dollar terms, gold has added $256 to its price. If you owned gold at the start of the year, you are feeling pretty good right now. But silver? Silver is up 24%. That is 4 times the percentage gain of gold. In dollar terms, silver has added nearly $17.50 to its price. If you owned silver at the start of the year, you are not just feeling good, you are feeling vindicated. So why the massive outperformance? Why did silver rally 4 times as hard as gold? The answer lies in a concept that every precious metals investor needs to understand. It is called the gold-silver ratio. This ratio measures how many ounces of silver it takes to buy 1 ounce of gold. Historically, this ratio has fluctuated wildly. In ancient times, it was around 15 to 1. In modern times, it has ranged from 30 to 1 during silver bull markets to over 100 to 1 during periods of silver weakness. Last year, the ratio briefly touched 100. That meant you needed 100 ounces of silver to buy a single ounce of gold. At that extreme, silver was historically cheap relative to gold. It was, as we said at the time, a coiled spring waiting to release, and release it did. Over the past 12 months, silver has rallied 150%. Let that sink in. 150%. If you bought silver a year ago, you have more than doubled your money. If you bought at the lows, you have potentially tripled it. This rally has pushed the gold-silver ratio to its lowest level since 2012. We are now at levels that many analysts consider unsustainable. Just as the ratio could not hold above 100 last year, many believe the current levels are living on borrowed time. But here is the key insight. The ratio does not mean anything by itself. What matters is why the ratio is moving. And the why is simple: supply and demand. Silver is unique among precious metals because it has a dual identity. It is both a monetary metal and an industrial metal. Unlike gold, which mostly sits in vaults and around necks, silver gets consumed. It gets used in solar panels, electric vehicles, electronics, medical devices, and 1,000 other applications that are growing rapidly. The world is electrifying. The world is going green, and every solar panel, every electric vehicle, every 5G tower requires silver. Not gold, silver. This industrial demand has been growing at a pace that the mining industry simply cannot keep up with. For years, analysts have been warning about a structural deficit in the silver market. The world consumes more silver than it produces. The gap has been filled by recycling and by drawing down existing stockpiles. But you can only draw down stockpiles for so long before they run out. This is the fundamental story that has been driving silver higher. The tariff narrative accelerated it. The fear of supply chain disruptions caused panic buying. But even without the tariffs, the underlying supply-demand imbalance would still exist. So, when silver rallied 24% in 2 weeks, it was not irrational. It was the market finally pricing in a reality that has been building for years. The problem is that the market tends to overshoot. It tends to price in not just the current reality, but the worst-case scenario of the future reality. And that brings us to the pullback. Gold ended the week below $4,600. Silver slipped back under $90. The traders who had been chasing momentum suddenly found themselves chasing their own tails. The algorithms that had been buying automatically started selling automatically. The momentum that had been pushing prices higher suddenly became the momentum pushing prices lower. This is normal. This is healthy. Markets do not move in straight lines. They move in waves. 2 steps forward, 1 step back. The pullback we are seeing now is the 1 step back. But here is what the mainstream media is not telling you. The pullback is not because the fundamentals have changed. The pullback is because the narrative has shifted. And the narrative shifted because of one man, President Donald Trump. We need to talk about what happened on Wednesday. We need to understand the Section 232 tariff review and what no tariffs for now actually means for the silver market. Because while the short-term traders are selling, the long-term investors should be paying very close attention. The fundamentals have not changed. The supply deficit has not disappeared. The industrial demand is not slowing down. The only thing that has changed is the fear. And fear, as we know, is the most volatile commodity of all. The market spent a year building a fortress of silver inside the United States. It stockpiled metal in anticipation of a war that may never come. And now it is waking up on a Sunday morning, surrounded by silver bars, wondering what to do with them all. This is the setup for the next phase of the market. This is where the weak hands get shaken out and the strong hands accumulate. This is where the real money is made. In the next part of this deep dive, we are going to analyze the Trump tariff decision in detail. We are going to explain what Section 232 means and why the words "for now" are the most important words in the entire announcement. The rally may be pausing, but the story is far from over. Late Wednesday, President Donald Trump made an announcement that sent shockwaves through the precious metals market. Following a Section 232 tariff review, his administration announced that it will not impose tariffs on critical metals. For now. Those two words. For now. They are doing more heavy lifting than a forklift in a silver warehouse. Let us break down what Section 232 actually means. Section 232 of the Trade Expansion Act of 1962 gives the president authority to impose tariffs on imports that threaten national security. It was originally designed to protect domestic industries that are critical to defense production. Steel, aluminum, the metals that build tanks and aircraft carriers. In recent years, the scope of Section 232 has expanded dramatically. The argument goes like this. If a metal is critical to modern technology, and if modern technology is critical to national security, then that metal falls under Section 232. This is how silver, a metal traditionally associated with jewelry and photography, became classified as a national security concern. And it makes sense when you think about it. Silver is essential for solar panels. Solar panels are essential for energy independence. Energy independence is essential for national security. Therefore, silver is a national security metal. The fear that drove the silver rally was simple. If President Trump imposed a 10%, 15%, or even 25% tariff on imported silver, the price of silver inside the United States would immediately jump by that amount. Any silver sitting outside the country would become that much more expensive to bring in, and any silver already inside the country would become that much more valuable. This fear drove a year-long stockpiling operation. Banks, dealers, industrial users, everyone with exposure to silver started building inventory. They were preparing for a tariff war that would segment the global market and trap silver inside national borders. We saw this play out in real time. The COMEX vaults in New York filled up with metal. The registered inventory, the silver that is available for delivery against futures contracts, swelled to levels not seen in years. The United States was building a strategic silver reserve, one warehouse receipt at a time. But then, on Wednesday, the president pulled the rug. No tariffs on critical metals. For now. The immediate reaction was predictable. The fear premium that had been baked into silver prices started to evaporate. Traders who had bought silver specifically to front-run the tariffs started selling. The algorithms detected the selling pressure and amplified it. Silver dropped from its highs and slipped back under $90. But here is what the headline readers are missing. The president did not say no tariffs ever. He said no tariffs for now. That is a very different statement. For now means the review is ongoing. For now means the administration is watching. For now means that at any moment, with a single tweet or executive order, the tariff hammer could still drop. This creates a new kind of uncertainty. The old uncertainty was binary. Will there be tariffs or won't there? The new uncertainty is temporal. When might tariffs happen? Under what conditions? What would trigger them? This uncertainty does not eliminate the fear. It transforms it. Instead of acute panic, we now have chronic anxiety. The stockpiles that have been built over the past year are not going to be liquidated overnight. The physical silver sitting in U.S. vaults is not going to suddenly fly back to London. The strategic reserves have been built. They are staying. And this is the key insight that the mainstream media is missing. The tariff threat may be paused, but the tariff response has already happened. The silver is already here. It is already trapped inside the United States. And it is not leaving anytime soon. Think about it from the perspective of a risk manager at a major bank. You have spent the past year accumulating silver inventory inside the United States. You did this because you were afraid of tariffs. The president now says no tariffs for now. Do you immediately start shipping your silver back to London? Of course not, because for now is not forever, because the geopolitical situation is unstable, because the president has a history of changing his mind, because the cost of being wrong, of shipping your silver out and then having tariffs imposed, is catastrophic. So you keep your silver where it is, you maintain your inventory levels. You stay prepared for a tariff war that may never come, because the cost of being unprepared is too high. This is the roach motel effect we have discussed before. Silver checks into the United States, but it does not check out. Even without formal tariffs, the threat of tariffs is enough to trap the metal. And the result is that the United States remains a silver fortress. The metal is here, the supply is secure, and the industrial users who need silver for solar panels and electric vehicles and medical devices have access to the metal they need. Meanwhile, the rest of the world, particularly London and the LBMA, remains vulnerable. They have been dealing with a supply drain for years. The flows to China and India have depleted their vaults. They were hoping that the tariff threat would fade and the silver would flow back across the Atlantic. But the silver is not flowing back. The roach motel remains in effect. This is bullish for silver in the medium to long term. The physical market may return to something resembling normal, as the analysts say, but normal is not what it used to be. Normal now includes a massive strategic stockpile inside the United States. Normal now includes chronic uncertainty about tariffs. Normal now includes a structural supply deficit that is not going away. The pullback we are seeing is a reaction to the headline. It is not a reaction to the fundamentals. And when the headline fades and the fundamentals reassert themselves, silver will resume its upward trajectory. In the next part of this deep dive, we are going to shift our focus to gold. We are going to explain why gold is facing headwinds that silver is not. We are going to discuss the Federal Reserve, interest rates, and the broken relationship between gold and the dollar. Because while silver has been stealing the headlines, gold has been fighting its own battle. And that battle is far from over. While silver has been grabbing headlines with its historic 24% rally, gold has been having a quieter, more complicated month. Yes, gold is up 6% in January. Yes, that is impressive. Yes, gold has added $256 to its price, but gold has also run headfirst into a wall. That wall is called economic reality. Let us talk about the Federal Reserve. For years, the precious metals market has operated on a simple assumption. When interest rates fall, gold rises. When interest rates rise, gold falls. The logic is straightforward. Gold does not pay interest. It does not pay dividends. It just sits there, being gold. When interest rates are high, investors face an opportunity cost for holding gold. They could be earning 5% in a treasury bond instead of holding a lump of metal that earns nothing. This inverse relationship between gold and interest rates has been a cornerstone of precious metals analysis for decades. But here is the thing. That relationship is broken. Over the past 2 years, gold has rallied from under $2,000 to nearly $4,600. It has more than doubled. And it has done this while interest rates have remained elevated. The Federal Reserve has kept rates higher for longer than anyone expected. The 10-year Treasury yield has stayed stubbornly above 4%. By all traditional metrics, gold should have struggled. But gold did not struggle, gold thrived. This tells us something important. The old playbook is dead. The traditional correlations that traders relied on for decades no longer apply. Gold is responding to forces that are bigger than interest rates. It is responding to geopolitical uncertainty. It is responding to central bank buying. It is responding to a growing realization that the global financial system is unstable. But even with the old playbook dead, gold still faces headwinds. And those headwinds are intensifying as we enter 2026. Recent economic data suggests that there is no urgency for the Federal Reserve to cut interest rates. The economy is resilient. Inflation, while lower than its peak, remains sticky. Employment is strong. The Fed has no reason to rush. This means that the first rate cut of 2026 likely will not arrive until at least June. That is 5 months from now, 5 months during which gold will have to fight against higher bond yields and a stronger US dollar. Patience, as always, remains the most expensive commodity. For gold investors, this creates a challenging environment. The long-term thesis remains intact. Gold is a hedge against uncertainty. Gold is a store of value in a world of currency debasement. Gold is the ultimate safe haven. But the short-term path is muddy. Gold ended the week below $4,600. That is a psychological level. That is a round number that traders watch. Closing below it is not catastrophic, but it is not bullish either. It suggests that the easy gains have been made and that the next leg higher will require more effort. But here is what I want you to understand. The headwinds facing gold are not existential. They are temporary. Interest rates will eventually come down. Maybe not in March, maybe not in June, but eventually. And when they do, gold will have one less obstacle in its path. Meanwhile, the factors that have been driving gold higher, the factors that broke the traditional playbook, are still in effect. Central banks are still buying. Geopolitical tensions are still elevated. The global debt situation is still unsustainable. These are not short-term factors. These are structural. They are not going away because the Fed delays a rate cut by a few months. So what does this mean for the gold-silver relationship? Some analysts are suggesting that gold has a slight edge over silver in the current environment. Their reasoning is based on the gold-silver ratio. Silver's 150% rally over the past 12 months has pushed the ratio to its lowest level since 2012. Silver has outperformed gold by a massive margin, and like all ratios, this one tends to mean revert. The argument goes like this. Just as the ratio could not hold above 100 last year when silver was extremely cheap relative to gold, the current low ratio cannot hold either. Silver has run too far, too fast. It needs to consolidate. Gold, on the other hand, has room to catch up. This is a reasonable argument. It is not wrong, but it is incomplete. Yes, the ratio is at multi-year lows. Yes, silver has outperformed dramatically, but the ratio does not exist in a vacuum. It is driven by supply and demand, and the supply-demand dynamics for silver are fundamentally different from those of gold. Gold is produced at a relatively stable rate. Gold demand is relatively stable. The gold market is mature and liquid. Silver, on the other hand, is in a structural deficit. Demand is growing faster than supply. The industrial applications are expanding rapidly. The solar boom is just beginning. The electric vehicle revolution is just beginning. The electrification of everything is just beginning. So while the ratio may mean revert in the short term, the long-term trajectory is clear. Silver has more upside because silver has more demand. This does not mean you should sell your gold. Gold is the foundation of any precious metals portfolio. It is the anchor. It is the insurance policy. But it does mean that silver, despite its recent rally, still has room to run. The question is timing. And timing, as we know, is everything. In the final part of this deep dive, we are going to look ahead. We are going to discuss what the rest of 2026 might hold for gold and silver. We are going to talk about strategy. And we are going to explain why, despite the pullback, this is one of the most exciting times to be invested in precious metals. The rally is pausing, but the bull market is not over. We have covered a lot of ground in this deep dive. We have analyzed silver's historic 24% rally. We have explained the Trump tariff decision and what, for now, really means. We have discussed gold's battle with economic reality and the broken relationship with interest rates. Now it is time to look ahead. What comes next for precious metals in 2026? Let me be clear about something. I'm not going to give you a price prediction for Monday morning. I'm not going to tell you that silver will hit $100 by February or $150 by summer. Anyone who makes those kinds of specific predictions is either lying to you or fooling themselves. What I will give you is a framework for understanding where we are and where we are likely going. Framework. Number 1. The pullback is normal. Markets do not move in straight lines. After a 24% rally in 2 weeks, some consolidation is not just expected. It is healthy. It shakes out the weak hands. It resets the technical indicators. It gives the market time to digest the gains. Some short-term selling pressure should not surprise anyone. What would surprise me is if the market continued straight up without any pause. That would be unsustainable. That would be a bubble. What we are seeing now is a bull market behaving like a bull market. 2 steps forward, 1 step back. If you're panicking because silver dropped below $90 after being below $40 a year ago, you need to zoom out. You need to look at the bigger picture. You need to remember why you were invested in precious metals in the first place. Framework. Number 2, the fundamentals have not changed. The tariff decision changed the short-term narrative. It did not change the underlying supply-demand dynamics. The structural deficit in silver is still there. The industrial demand is still growing. The mining supply is still constrained. The silver that was stockpiled inside the United States over the past year is not leaving. The roach motel effect is still in place. The threat of tariffs has not disappeared. It has simply been postponed. Meanwhile, gold continues to be supported by central bank buying and geopolitical uncertainty. The Fed may delay rate cuts, but rate cuts are still coming. The global debt situation is still unsustainable. The reasons to own precious metals have not changed. Framework. Number 3, a return to normal is not really normal. The analysts are saying that the physical market may finally return to something resembling normal. But what is normal? Normal used to mean a liquid global market where metal flowed freely across borders. Normal used to mean London and New York operating as a unified pricing hub. Normal used to mean abundant supply and stable demand. That normal is gone. The new normal includes strategic stockpiles inside national borders. The new normal includes chronic uncertainty about tariffs and trade policy. The new normal includes a structural supply deficit that is not going away. The new normal includes a broken relationship between gold and interest rates. This is not the old normal. This is a new paradigm. And in this new paradigm, precious metals are more important than ever. Now let us talk about strategy. What should you do with this information? Strategy number 1, do not get shaken out. The volatility will continue. There will be days when silver drops $3. There will be days when gold falls $100. The algorithms will trigger stop losses. The media will scream about crashes. The weak hands will panic and sell. Do not be a weak hand. If you understand the fundamentals, if you understand the structural deficit, if you understand the long-term trajectory, then short-term volatility is noise. It is an opportunity to accumulate more, not a reason to sell. Strategy number 2, think in terms of replacement cost. The spot price you see on your screen is increasingly disconnected from the price you would pay to acquire physical metal. Premiums are elevated. Dealer inventories are tight. The street price for physical silver is higher than the paper price. When you evaluate your holdings, do not think about the spot price. Think about what it would cost to replace your stack if you sold it. Could you buy it back at the same price? Probably not. That tells you something important about the true value of what you own. Strategy number 3, diversify within precious metals. Gold and silver serve different functions. Gold is the anchor. It is the insurance policy. It is what you hold when you want stability and preservation of wealth. Silver is the accelerator. It has more volatility, more upside, and more industrial demand. A balanced portfolio includes both. The exact ratio depends on your risk tolerance and investment goals, but do not make the mistake of being all in on one metal. Diversification within the precious metal space is just as important as diversification across asset classes. Strategy number 4, ignore the noise. The mainstream media will focus on the wrong things. They will focus on daily price movements. They will focus on Fed meetings. They will focus on whatever Trump tweeted today. You need to focus on the fundamentals: supply, demand, inventory levels, industrial consumption, central bank buying. These are the factors that drive long-term prices. Everything else is distraction. Let me leave you with this final thought. We are living through a historic moment in the precious metals market. Silver just posted its best start to a year since 1983. Gold is within striking distance of all-time highs. The traditional playbooks have been thrown out the window. The old correlations are broken. The old assumptions are invalid. This is both terrifying and exhilarating. Terrifying because the uncertainty is real. Exhilarating because the opportunity is generational. The rally is pausing. The market is catching its breath. But the bull market is not over. The fundamentals are too strong. The supply is too tight. The demand is too persistent. This is not the time to sell. This is the time to hold. This is the time to accumulate. This is the time to stay patient and trust the process. Thank you for being part of this community. Thank you for watching to the end. If you found this analysis valuable, please do me a favor. Drop a comment below saying, "Staying with the original." Subscribe if you have not already. Hit the notification bell so you do not miss our next deep dive. The rest of 2026 is going to be extraordinary. The pullback is temporary. The trajectory is clear. And the opportunity is now. Gold ended the week below $4,600. Silver slipped back under $90. But these are not endings. These are pauses. Brief moments of consolidation before the next leg higher. Maybe give silver a chance to catch its breath. But do not take your eyes off the prize. We will see you in the next video. Stay safe. Stack smart. And remember, the paper price is not the real price. The real price is the one you pay when you try to buy the metal. Until next time.